Hooters of America filing for bankruptcy.
What's happened with Hooters?
Latest casual restaurant chain to file for Chapter 11 bankruptcy.
Filing for bankruptcy.
40 have shuttered in the U.S. in the past year alone.
Being totally bankruptcy.
Bankruptcy?
For bankruptcy?
To bankruptcy.
For bankruptcy?
Hooters was started in 1983 in Clearwater, Florida, when 6 businessmen decided to open a restaurant that was part joke, part business venture. The founders, Lynn D. Stewart, Gil DeGianantonio, Ed Droste, Billy Ranieri, Dennis Johnson, and Ken Wimmer, openly admitted they had no real experience in the food industry. Their idea was simple: combine sports, beer, and attractive waitresses to create an everyman's paradise. They called it Hooters, a cheeky reference to owls and, well, the obvious double meaning. What started as a novelty quickly exploded into a business model that attracted attention for all the right and wrong reasons. Within just a few years, Hooters expanded rapidly, turning its unique blend of food and flirtation into a franchising powerhouse. By the early 2000s, Hooters had grown to over 400 locations worldwide. Its revenue wasn't driven solely by food. Alcohol sales were a huge part of its profit margins, alongside merchandise like t-shirts, calendars, and branded souvenirs. The Hooters girl became more than an employee. She was the face of the franchise. Featuring prominently in marketing campaigns, bikini contests, and even TV shows, the Hooters girl became a cultural icon, albeit a controversial one. But underneath the fun, a more complex financial picture was brewing. Hooters had built its brand on a very specific type of appeal, one that was closely tied to 80s and 90s culture, where edgy, male-centric advertising dominated. As the 2010s rolled in, social attitudes began shifting. Millennials and Gen Z customers weren't as attracted to the restaurant concept. Women increasingly entered spaces that were once male-dominated, and brands that relied on objectification faced growing backlash. Meanwhile, new competitors like Twin Peaks and Tilted Kilt entered the market, offering similar experiences but with updated, trendier atmospheres. Financial cracks started to show. Hooters wasn't just facing cultural headwinds. It was also dealing with rising labor costs, lawsuits from employees over workplace discrimination and harassment, and operational challenges from an aging brand image. At its peak, Hooters had over 430 locations globally. But by 2018, reports indicated the chain had quietly closed dozens of underperforming stores. Analysts began speculating. Was Hooters' business model sustainable in the modern era? In 2011, Hooters was sold to a private equity consortium led by Chanticleer Holdings. Private equity firms are known for buying struggling companies, cutting costs, and flipping them for profit. But instead of a turnaround, Hooters' decline continued. The brand tried to pivot by launching Hoots, a spin-off fast casual concept that focused solely on food and ditched the signature uniforms. The idea was to attract a broader audience: families, women, and people who might otherwise avoid Hooters' main brand. But Hoots failed to scale at the speed investors hoped for. Without the Hooters girl marketing hook, the chain struggled to stand out in an already saturated fast casual dining market. Behind the scenes, Hooters' franchising model was under strain. Franchisees complained about shrinking profits, rising fees, and outdated menus. Customers complained that food quality wasn't keeping up with competitors. And culturally, Hooters found itself caught between two worlds. Too edgy to appeal to socially conscious diners, but not edgy enough to maintain its original rebellious charm. By 2019, the company was sold again, this time to Nordbay Capital and Tri-Artisan Capital Advisors, another private equity group. Private equity ownership often signals cost-cutting, asset stripping, or a last-ditch attempt to revive a declining brand. For Hooters, this meant more store closures, consolidation of operations, and yet another effort to modernize the brand's image. But was it too little, too late? Let's talk numbers. While exact financial details are private due to its ownership structure, estimates suggest Hooters generated around $850 million in annual revenue during its peak years. But those numbers have reportedly declined steadily over the past decade. The chain's U.S. footprint shrank from over 430 stores to under 310 by the late 2010s. International expansion, once seen as a growth driver, stalled. Countries like Japan and Australia embraced the novelty of Hooters early on, but eventually cooled on the concept, leading to closures abroad. Adding to its woes, Hooters faced multiple lawsuits alleging discrimination, unfair hiring practices, and hostile work environments. Legal fees and settlements, combined with rising insurance costs, further squeezed margins. And then came the pandemic. COVID-19 hit the casual dining industry hard. With dining rooms shut and sports events canceled, a restaurant like Hooters, built around live sports, beer, and in-person experience, suffered deeply. While some locations pivoted to takeout and delivery, Hooters' business model wasn't designed for off-premise dining. The pandemic accelerated what analysts feared, a decline toward potential insolvency. But why couldn't Hooters simply rebrand? After all, other legacy chains have modernized their images successfully. The answer lies in the very DNA of the brand. Hooters' name, logo, and uniforms aren't peripheral. They're the core of its identity. To change them would be to erase what made Hooters, well, Hooters. But leaving them unchanged alienated younger customers who viewed the brand as sexist, outdated, or simply irrelevant. Some observers argue that Hooters is a classic example of a company locked into a business model that thrived in one cultural moment but can't evolve without losing itself. It's the textbook innovator's dilemma: adapt and lose your original customers, or stay the same and fade into irrelevance. And fading it is. Reports indicate that many franchisees are struggling to turn a profit. New franchise applications have slowed. Employee turnover remains high. Even merchandise sales, once a bright spot, have reportedly declined. So is bankruptcy next for Hooters? While the company hasn't filed for Chapter 11, some analysts suggest it's a question of when, not if, unless drastic changes are made. Private equity ownership might stave off bankruptcy by injecting short-term capital, but without a long-term solution to the brand's identity crisis, financial struggles are likely to persist. Hooters' story raises a fascinating question. Can a brand built on controversy survive a world that's moving beyond it? In its heyday, Hooters thrived by embracing male-centric marketing and pushing cultural buttons. But as norms shift, businesses built on objectification are finding their models less sustainable. Customers now expect inclusivity, diverse marketing, and ethical employment practices, things that clash with Hooters' original formula. That's not to say the brand couldn't pivot. Some suggest leaning harder into nostalgia, selling itself as a retro experience for older customers who grew up with it. Others advocate for transforming Hooters into a mainstream sports bar, minimizing the focus on staff appearance and emphasizing food, drinks, and sports atmosphere. But either path requires investment, bold leadership, and a willingness to shed or double down on its controversial legacy. Meanwhile, competitors like Twin Peaks and Tilted Kilt have gained market share by modernizing the restaurant concept with better food, more immersive decor, and fresher branding. At the same time, sports bars like Buffalo Wild Wings have captured customers looking for a family-friendly sports experience without any of the controversy. In 2024, Hooters' future remains uncertain. While not yet bankrupt, the signs of financial distress are clear. Shrinking footprint, struggling franchisees, changing customer demographics, and a brand image increasingly out of step with today's values. Unless Hooters can find a way to reinvent itself or carve out a new niche, it risks becoming a relic of a bygone era. At the end of the day, Hooters is more than a restaurant chain. It's a case study in the power and peril of branding. Its bold strategy created a billion-dollar empire at its peak, but the same strategy has become its greatest liability. So the question remains, was Hooters a marketing genius or a business model that was risky from the start? Let me know what you think in the comments. Do you believe Hooters can still turn things around, or is the brand destined to disappear? And if you enjoyed this deep dive into the business behind Hooters, don't forget to like, subscribe, and hit the bell for more videos breaking down the world's most fascinating and sometimes controversial companies.